Hello, my name is Tiffany C. Wright, and today I'm here to talk to you about building business credit, separating yourself from your business through building business credit. As I've stated in all my previous presentations, it's important to view your business as a marketable asset, a source of long-term wealth, a creator of jobs, and a source of investment income for yourself and others who believe, otherwise known as investors. This is key. When you view your business as such, you take actions and make decisions that make your business a viable, saleable asset. You put in the infrastructure, you hire the people, you just look at your business much differently than if you're just viewing your business as a source of your personal income or the supporter of your lifestyle. Cash flow is the lifeblood of any business, no matter the size. If your company does not have adequate operational cash flow, that is, cash generated on a daily or weekly basis from daily operation of your business, then you have to access cash from selling assets, which is cash flow from investing, or from financing. I'm referring to your cash flow statement. Cash flow statement is organized into three parts: cash flow from operations, cash flow from investing, cash flow from financing. So to access financing, either you as the business owner or your business needs credit. If you want to keep your personal finances completely separate from your business finances, you will need to establish credit for your business that is completely separate from you or the investor, whomever's credit is being used. In other words, you will want to obtain supplier terms, bank loans, and equipment financing with only the company's performance or assets as a guarantee of performance, not your assets or your investor's assets or signature as a guarantee. Imagine this scenario. Your business has been doing extremely well, but two of your largest customers file for bankruptcy and you didn't see it coming. That could wipe out your business cash flow overnight, especially if you hadn't been managing your receivables tightly and those customers owe you a large sum of money. But regardless, you'll still need time to build relationships and replace those customers. Your business may encounter financial distress in the interim as a result. If the company subsequently cannot make its payments on loans or to suppliers, or if you have personal guarantees in place, those guarantees could be called upon. So in the case of a failing company, whether temporarily or permanently failing, you would lose the income the business paid you as a salary. This is as the owner. You would lose your salary, plus you would have to make loan repayments out of your personal assets. It just went from bad to worse. What if all you had was tied up in the business? Well, if the company has to file for bankruptcy, you may also have to file for personal bankruptcy. If you had standalone business credit, your personal finances would not be an issue. You may choose to inject money into the company, but you would not have to inject it. In a less serious scenario, your company has encountered some difficulties due to the current economic environment and now the recovering recession. You would like to negotiate better terms on your loan or with your suppliers. If the company is the sole guarantor and the company is struggling, assuming you had a decent plan to weather the storm, your lender is highly likely to negotiate with you. However, if you are a guarantor and have sizable assets, why should the lender negotiate when they can pursue your assets and be done with it? Of course, having a strong relationship with your lender always helps. So some of the whys to building business credit, in the order that we've covered them in this presentation, are: position your company as a standalone saleable asset independent of you as an owner. That is a good reason to build business credit. Another one is to shelter your personal assets from a business downturn or failure or a business bankruptcy. And building business credit puts you in a stronger negotiating position with banks because they don't have your personal assets to go after. On the opposite side, many business owners complain about how all the credit they have for the business in their name drags their personal credit scores down. By separating and building your business credit profile, you as the business owner can get business credit cards, equipment loans, etc. in the business's name and tax ID number. Consequently, the business loans will not be associated with you as the owner, will not be associated with your Social Security number, and thus will not impact your personal credit. Okay, enough of the what-if scenarios and the whys. You get the gist behind the reason for having a strong business credit profile, or behind the reasons for having a strong credit profile. For emphasis one more time, here's what Wells Fargo Bank has said regarding separating business and personal credit and financing. The longer you delay establishing business credit, the longer you delay taking advantage of business loans. To paraphrase this, the stronger your business credit profile, the more types of business loans your business has access to. By strengthening your business credit, you will not have to use the owner or shareholder's guarantee for loans, leases, credit cards, and other sources of debt financing. If your business has a strong operating history and financials to support this, you can easily build your business's credit. To do so, if you haven't already done so, please take the following 7 steps. Make sure you are registered with Dun & Bradstreet, otherwise known as D&B, and that you have a D&B number. Then sign up for the free self-monitoring system. You may want to sign up for some of their other services, but the self-monitoring system is free. Obtain credit cards from Staples, Office Depot, or other office product providers up to the amount allowed with no guarantees. Then use these cards to purchase your office supplies. Obtain credit cards from Home Depot, Lowe's, or other office improvement entities, and then use those credit cards to purchase any repair or cleaning items for the office. All of these entities report to D&B and Experian. If your business has lines of credit with any of your vendors or suppliers, ask that they report this information and the performance to D&B. If you do not have any lines of credit with your vendors or suppliers, ask for them. And then each year, see if you can increase the size of the credit line. Make sure you use it as appropriate to keep the credit line there. For example, if you have a $50,000 credit line, but always pay within 10 days by check, then your credit line will disappear, and it may disappear when you need it most. You should place your orders using the credit line, then pay off the credit line every 30 to 60 days, depending on what the terms of the payment are. If you have a business loan from a bank or other financial institution, even if it is guaranteed by you as the owner or by another individual, example, an investor, make sure that the loan is under the company's tax ID and is reported on the company's credit report. Make sure of this. If it is in the company's name, but for some reason it is under someone's Social Security number, get that changed. Get that changed so that it is reporting under the business's tax ID and under the business's credit report. All banks report to D&B regularly. Therefore, making consistent on-time payments on your company's bank loan can very positively impact the business credit. Check your D&B report quarterly, but no less than annually. Make sure that any loans, leases, or other debts showing are correct. Many times, entities report when they file a UCC, which is a Uniform Commercial Code, but they do not report when the loan is paid off. Hence, paid off or retired loans and leases may still be showing on the company's credit report, which makes it seem like the business has a much higher debt ratio than it actually does, and that, of course, suppresses the company's credit rating. Pay your suppliers within their specified terms. Make sure that you are working with at least 2 suppliers who report to DMB and/or Experian. Otherwise, your great payment record will be completely unknown. If the supplier does not report to Dun & Bradstreet, request a letter of payment history. Again, that's a letter of payment history from the supplier, and then submit it yourself to DMB to add to your business's credit profile. Provide reviewed or audited financial statements to DMB. You may not want to provide these because your company is private, but be aware that lending entities often provide abbreviated information to DMB for the purpose of reporting. You want DMB to have accurate information. So why not report your own information yourself? If you still are leery about releasing your company's full financial statements, privacy concerns, concerns about your competitors, and so on, then consider providing just the annual revenues and the balance sheet or a snapshot of it via a statement from your CPA. Finally, you should have a business plan. Banks and other lending institutions will look at the company's credit profile, its financial history, financial projections, and the business plan, or an abbreviated version of it, in making its decision. So if you do not have a business plan, those entities obviously cannot factor that business plan into the decision making. Can't use what you don't have. For additional information and to get started, you can check out my book, Solving the Capital Equation, Financing Solutions for Small Businesses. It's available on Amazon. It's written in the same format that I am speaking now. It's easy to understand in very simple terms. There's, I believe, 25 case studies, and it's rife with examples. It just walks you through from a top-down perspective when to obtain financing, what sources depending on your industry, the size of the company you have, the growth period your business is in, when to provide or when to go after that particular type of financing, and how to package yourself accordingly. Thank you very much. My name is Tiffany C. Wright. I am the Resourceful CEO. You can follow my blog at www.cashforimpact.com. There's other information there, and I'd love to hear from you.